Hello and welcome. You're watching KYC. I'm Harsh Saita. With me is Varsha Chandani, and of course, no guesses, likely a pharma company, right? But we've had a good set of numbers coming in from Dr. Lal. Would you say that, Varsha?
Yeah.
Yes, and therefore, you'd want to know as to whether after the entire normalization in terms of numbers post-COVID, whether pathology labs are really one way to play pharma and domestic pharma, given that there is exposure coming in from global, which is coming in through tariffs. So, therefore, this conversation becomes relevant. And we'll start off by understanding what I want to know and why Dr. Lal PathLabs. One is volume growth sustainability. Now, Q1 was a good quarter where volume growth is concerned, and want to know whether that can sustain all through FY26 or not. Really, that's going to be the one key question which we'll want answers to. The second one is with regard to margins and growth guidance. The gross margins have improved and improved quite well, and that is reflecting on the EBITDA margin as well, Varsha. The guidance seems to be 27%, but they've done 28% in terms of EBITDA, both in FY25 as well as in Q1. So that's impressive. Whether that can sustain, and therefore what's the guidance like? They've guided for, I think, 11% top line growth for FY26. So whether that changes at all given volumes. So we'll talk about all of that. The third piece is with regard to radiology. Now, is this going to be the new growth lever to kick through when it comes to a Dr. Lal? It's synergistic with its business, and therefore, could this be one of those pillars on which it builds on and further creates efficiencies within its business? That's what I'd want to know. Radiology, is that the new lever? And now then there's the other lever of Suburban as well. The acquisition of Suburban has left plenty on the table in terms of room for operational efficiency to play through. Timing of that has been a bit iffy from the management. I'd want to know whether there is something in terms of timing that they can give us. Swasthfit is the other one. Extremely strong set of numbers coming in, driven by Swasthfit. The margins also of Swasthfit have been really, really impressive. Can that kind of a growth clip continue? And then you have pricing. Pricing is the other lever where there's been a bit of a drag where Dr. Lal is concerned. And therefore, whether pricing improvement can actually happen, and is that on the anvil, and that will obviously impact top line, is what I'd want to know. Unlikely, Varsha, on this count, but I mean, it's just something I'd want to know.
On the pricing front, I would say that Dr. Lal, they clearly, in last few quarters, they clearly told that they don't want to go for price hikes. They want to play on volumes.
Correct.
And that's the reason you're seeing that there's been a good volume growth, though.
But Varsha, you look at across the hospital space, you've seen price increases rampant, right? And therefore, on the testing side, if you're not seeing price increases, at some point that has to correct, right? It has to adjust itself for inflation. So I'd want to know as to whether they're actually doing that or not. And obviously competition texture, because that will also play through on pricing a little bit. So all of that, of course. But let me first start off with, or rather, I'm going to shift focus entirely to Varsha now. She's going to drive about the company, and she does this well. So Varsha, over to you.
Let me start with that, that as Harsh was saying, because of this all tariff situation, you have hospitals, you have diagnostic companies, so basically they are on the radar of the investors. Why? Because you don't have that overhang of tariffs, playing out in diagnostics and hospitals, and diagnostic itself is growing into double digit, and that's one of the reasons you're seeing many upcoming IPOs. Recently we had Suraksha Diagnostics, and many diagnostics are in focus when it comes to investors because of again the double digit growth and no overhang when it comes to tariffs. But shifting our focus to Dr. Lal, let's see what that company does. I think our viewers know very well what this company does, but still it operates a diagnostic change with a pan-India presence, and in the last 5 years they have served 131 million patients, and when it comes to pathology and radiology tests, they have almost 5,000 overall 5,000 pathology and radiology test comprehensive test menu. They have 298 labs, and they are geographically spread out network. On the operating highlights, when it comes to Dr. Lal, the number of clinical labs have been improved since 22. If you see in FY22, they were operating 277 labs, which has increased to 298 labs when it comes to FY25. On to the revenue by geography, if I were to talk about, their major focus is in Delhi, which contributes almost 31% to the overall revenue. Now this is followed by East India at 15%, then rest of North of 13%. Then you have also South India, which contributes 6% and others at 2%. So overall, their major focus has been into, Delhi, but they are expanding when it comes to West India, West and South markets as well. And let's see how they goes up, because the point here is it's very easy to open a diagnostic lab, but it's very difficult to scale that up. And that's one of the reasons, if you see, the diagnostic industry has been clustered. You don't have any diagnostic company, with a major pan-India presence. Dr. Lal has done a good job when it comes to pan-India presence. But
this is also more of heartland India, right?
Yeah.
You look at the tilt. 50% is Delhi, NCR and UP, virtually, and just the balance 50, and even out of the balance 50% is East and West, essentially. So, I mean, would you want to see South start to dominate? I'm sure, and I'm sure that that's the way they look at it as well.
That will actually require some time, Harsh, because, scaling up a diagnostic industry is actually difficult, and that's one of the reasons, Dr. Lal, being the king of the diagnostic industry, has been facing, I won't say a problem, but yeah, they're very little slow when it comes to, expansion, and that's not their fault. It's the industry, how that operates, and that's also one of the reasons why they are going for acquisitions. Into those areas where you don't want to open up a lab and then go into all those hustle, just acquire a lab and just move on.
Sure.
So this is how industry operates. But on to the overall, if you see, so there's nothing much. They just operate a diagnostic chain. Just because I'm talking about the company, I just wanted to highlight how their Q1 numbers were. The revenue growth that you're seeing is led by the sample volume. SwasthFit contributed 27% in Q1 FY26, and EBITDA increase that you're seeing is led by sustained volume growth, and lastly, network expansion and favorable mix also aided EBITDA. So overall, Harsh, a very simple business to understand, but a very difficult to scale that up.
Well, yes. Okay. So that's with regard to Dr. Lal. Let's start off and look at the metrics that we'll speak about with regard to where Dr. Lal is concerned. We'll start off with the income statement, the balance sheet, the regular metrics, frankly, cash flow, return ratios, shareholding, street cred, street coverage, and valuations. That's broadly how we always do it, and for all of you viewers, this is not new. So I'm going to go straight across to Varsha, who will start with the income statement.
Yeah, thank you for that. So overall, if you see the income statement, goods on the 3-year basis, starting from FY23, they've done a good business. So if you see, they've consistently delivered strong revenue growth. Mainly, almost they always have a guidance of 11 to 12%, and even in this financial year also they're expecting that, and they've decently done well. Now this revenue growth that you're seeing is primarily driven by increasing patient volumes and strategic network expansion into tier 3 and 4 cities. And of course, if you see the margins, look at the margins. Margins have improved. So in FY23, from 24% to 28%. Now this is on the back of favorable product mix, and of course the cost optimization strategies that the company has been doing, and of course the volume growth that the company has seen. So beautifully they've increased their margins, and even net profit has been increased, of course, because of the revenue growth, the cost efficiencies, and the margin improvement that you're seeing. So overall, Harsh, what they have guided in the last 3 years, on and off, 1 or 2 quarter might see, some on and off things, but overall, yeah, they've done a good job when it comes to overall income statement.
Yeah, I mean, last 3 years, every single guidance that they've put out, what stood out for me when I was researching this, they've exceeded the guidance every single time. So they have a record of really doing well where guidance is concerned. So that's the one key positive which viewers must know. Okay, let me now talk about the balance sheet, and it's a fairly simple one, so I'm going to just breeze through it. You look at the equity and the reserves, they're at around 2,100 odd crore. It's trading at nearly 12 to 13 times its book value, which is on your screen. The borrowing is minuscule, frankly, and currently at FY25 it's zero when I exclude lease liabilities. So on the liabilities column, all of that 157 crore is lease liabilities. No concerns with regard to the balance sheet, absolutely clean. When I'm looking at the cash reserves as well, it's sitting on a healthy set of cash of around 840 odd crores. So no concerns on that count either. Varsha, cash flow.
Yeah, so you know, if you see the cash flow from operating business in FY23, it was 456 crore, which has gone up to 569 crores. On the net cash flow, that the negative number that you're seeing in FY25 is because of the investments or cash flow from investing activity that they've done. They've invested in some investments, and that's the reason you're seeing that negative number. So overall, a good healthy cash flow that you're seeing. I'll also take Harsh on the ratio side, because if you see, the ROCE has increased from 24% to 48%. Now, one of the reasons why this has increased, because company do not operate in radiology. When it comes to radiology business, that business is a capital intensive business, and that's one of the reason. If you see, for Vijaya Diagnostic, the margins have been higher and ROCE has been lower because of the capital intensity that radiology business has with higher margin. So if you compare it with Dr. Lal and Vijaya, you would see the margins of Vijaya higher because radiology has a higher margin, and it's a capital intensive business, and that's one of the reason the ROCE of Vijaya Diagnostics is lower, but the ROCE of Dr. Lab is higher because they do not have much contribution from radiology business. So overall, good set of numbers when it comes to ratios. Yeah.
And fascinating nugget, you'll always get these small nuggets from Varsha when you bring her on KYC. So that's the other big positive. Let's look at shareholding now. And within that promoter shareholding, fairly steady. Again, I'm not going to waste too much time here. It's been 50+% for maybe the last 10 years odd. So no concerns with regard to shareholding. There's decent participation from FIIs as well. FII participation currently stands just above the 20% mark. The highest in the last 10 years was 26%. So some scope for it to go up. And DIs also have a fairly solid shareholding at this point at its peak of 17.6%. So that's on shareholding. Street cred also, let me take up actually. Let's quickly look at street cred. We've given this a neutral largely because you look at the 5-year returns. It's been, that's the way it's been. But the 1 month, the 6 month, the 12-month performance has been okay. The last 1 year, not any solid returns, and therefore we've given this a neutral. Let's go across to Varsha. Varsha, you want to take valuations and analyst recommendations?
Yeah, so on the valuation side, Harsh, if you see the PE, the TTM, trailing 12-month PE for Dr. Lal stand at around 51, and if you compare it with, Metropolis, Vijaya Diagnostics and Thyrocare, it's available at kind of discount to all these players. When it comes to FY27 PE, again, Dr. Lal is at 45, and Metropolis is at 42, ranging at the same level, while Vijaya Diagnostics has a higher PE. Now, one of the reasons, again, the radiology business, which, Vijaya has a good contribution from radiology, and that's and higher margins, and that's the reason the premium valuation that you're seeing in Vijaya Diagnostics. So overall, on a valuation side, yes, Dr. Lal normally has a premium valuation considering the management pedigree and the a decent business that the company has been, and of course the guidance that they meet the guidance. So overall, I would say a neutral set of rating when we would give to valuations.
Sure, let's look at analyst recommendations as well. Just a 6% upside is what average analysts on the street expect. 17 buy calls, 4 holds, 7 sells. So clearly not too many in the hold and the sell camp versus the buy. We've given this a neutral as well, just given the upside being just about 6%. But let's quickly stack up all of the rating parameters, and what we'll get is a very, very healthy 6.5 on 8 for a Dr. Lal PathLabs. And in fact, let's also go across to the conversation. Let's pull up, there you go, 6.5 on 8. And let's go across to the conversation Varsha and I had with Shankha Banerjee, the Chief Executive Officer at Dr. Lal PathLabs earlier today, and understand what the outlook is, not just for FY26, but what is in store for FY27 also. Listening. Let me first start off, sir, with the Q1 numbers, especially on the volume front. It's been a decent quarter for you. Question is sustainability and any one-offs at all. Is this at all weather linked, given the early onset of monsoon? Has the testing in the system gone up in terms of, are you seeing better volumes because of that, or is this largely just better trends playing out?
Good morning. Thanks for having me on the show.
Good morning.
I think that's a very interesting question, and thanks again for the compliments. Yeah, so the numbers this quarter are obviously quite good in terms of our sample volume, which is now seen a 10.7% growth in our overall revenue growth of 11.3%. Now, our quick analysis shows that this is really not driven by seasonal swing or anything getting preponed. It is primarily like for like versus same quarter last year. So yeah, I mean, this should be sustainable, and all the efforts that we've been making in the last 4 to 5 quarters are kind of bearing fruit in some way.
Right. Hi, Mr. Banerjee. Welcome to the
Hello.
show and pleasure to have you. Mr. Banerjee, if I remember, you had guided for 100 basis points margin compression in FY26 due to the reinvestment that Dr. Lal has been doing. Was Q1 strong margin an anomaly? And if yes, should we expect this compression to be delayed?
So, our margin profile usually is better in the first half compared to the second half. And Q1 margins are not really indicative of the full year. However, the margins that we have seen in Q1 are kind of also making us recalibrate the whole margin situation for the whole year. I think we'll be in a better place to maybe look at the guidance again after H1 is over. But as of now, it appears that we should do slightly better on the margins compared to, I think, what we had guided at the beginning of the year.
Okay, so basically, you're not expecting the compression in the margin going forward, at least for the H1. Okay. Also, yeah, please go
No,
ahead.
sorry, I'll just correct that a bit. I'm saying that we have H1 is definitely a better margin profile than H2 for us, and we had guided a compression in the margin for the full year compared to last year full year. So we will recalibrate by end of H1, and then we'll see. But it looks like we should be able to do slightly better than whatever we had guided earlier.
Okay, understood. Got that point. Also, Mr. Banerjee, so there's been good growth when it comes to pickup points as well. Now, when do you expect to see a significant step up in revenue beyond 15%? I mean, I agree that Dr. Lal has been growing above industry, but can you see, because of the uptick in the pickup points, can you see your revenue growth beyond 15%?
So right now, I think our revenue growth that we have guided is between 11 to 12% for this financial year, and Q1 is kind of in line with that. We will prefer to take this step by step. Yeah, one would obviously like higher revenue growth. The infrastructure addition that we are doing, whether it's in terms of the new labs that we are adding, the collection network, including pickup points, have a trajectory or a maturity trajectory which is slightly longer, and it usually will not have a direct correlation to growth in the immediate future. So yeah, I mean that infrastructure work or addition will continue, but our guidance for revenue for this year remains between 11 to 12%, and we are hoping to achieve that primarily driven by volume growth and whatever mix improvement that we can get. We haven't yet factored in any price increases.
So what's happening on the suburban front? Give us that perspective. You've guided that you're being cautious with regard to making large-scale changes within this model. How quickly do those changes come in? What should be the year in which everything should be effective, and what should the impact of that be on your numbers?
So, what we have done is last quarter of previous year, we have now completed the full integration with all the whole range of IT integration also completed. That has given us a bit of a market, disturbance, which has caused in a bit of a slowdown for a period of time. We are recovering on that growth. Also, now with the whole suburban diagnostics as a entity getting merged, we are more looking at West as a region to see how is that going to grow, because now there is, fungibility between suburban and Lal PathLabs in certain areas. So that's what we are going to track. And our West region growth, we are looking forward to kind of start coming back to the numbers that we want maybe in another quarter or so.
Got that. Also, Mr. Banerjee, now coming to your, Swasthfit portfolio. Now you've seen almost 20 to 22% growth when it comes to, that portfolio. Is this growth sustainable, or you're, expecting a higher growth also in, in the coming quarters?
So our Swasthfit growth, as you rightly said, has been 22% for this quarter, and the contribution has inched up further. It's now 27% of our revenue numbers, and we still see some bit of headroom available for this growth to continue, specifically, driven by the fact that not only urban markets, but we are seeing, the acceptability of the Swasthfit bundle packages in some of our tier 2, tier 3 towns and below as well. So that is kind of helping us, besides whatever we are driving in our core markets in terms of Swasthfit portfolio.
Okay, also on the radiology, so how do you view radiology as your, future growth driver? Because there are competitors, offering services like ECG at home. How will Dr. Lal PathLabs approach these basic and advanced, radiology services going forward?
Yeah, so radiology, like you said, is can be broken into basic and advanced. So in some of our metro markets, we offer the basic radiology services like X-rays, ultrasound, ECG, treadmill tests, etc. But high-end radiology, which is CT, MRI, and all, that's not something that we are kind of into too much. But even in the basic radiology that we do, currently that contribution is pretty low. So that is something that we are continuing to evaluate as to, how can that business model help us grow in the future. As of now, our focus remains on pathology and scaling pathology, but that radiology option is also always available to us, and we are continuously evaluating, that part of the, testing portfolio as well.
Mr. Banerjee, any kind of any number or any target that you have when it comes to radiology? Maybe in next 2 to 3 years, you want to take X percentage of revenue contribution from that segment.
Right now, like I said, we are just evaluating, because the business model around the high-end radiology works quite differently from the way the pathology business works. So we haven't yet, we don't have a business plan which is, targeting a certain growth coming through radiology. But yeah, we will continue to evaluate that, and maybe when the opportunity is right and our plans, maybe then create plans to see how we can add that to our portfolio.
All right, that's in fact all the time we have on this edition of KYC. From Varsha, myself, everyone who puts the show together, thanks so much for watching, and we hope you found this helpful.